for the investors of the company. We can use, and I'm not going to go through this, we'll actually go through it in class, but if you could go and take your company, use this little template, if you will, and gather this information for your company, we can plug that into a table and ultimately determine the value of our company using this dividend discount model. Plugging those numbers into our model, you can see that the expected return, the expected price of this stock, is roughly $38.95. The component parts to this, what do we need to know? Well, the things we need to know is what's the required return. If you use our formula that utilizes beta, right, our required return, K sub S here, the cost of equity, is 11.42%. But if you use the simple dividend yield plus capital gains calculations, it's 9%. Now this 2.5%, I gathered that from Yahoo Finance. So it's somewhere between 9 and 11.42%. So I said I'm going to use something in the middle. I'm going to use 10%. How did I get the growth rate? Well, I gathered the information from the dividends. I started out at 84 cents, went to $1.28 for 4 years. It's 11.10%. But if you look at the simple growth model, that retention model, the growth rate is like around 2.1%. So again, I use something in the middle around 6.5%. So I get a value of $38.95, but the stock price is $53.20. So obviously, this dividend growth model says that this stock is currently overpriced by the market. So we can't use this model if growth rate's not constant, right? We're making an assumption that it's constant. But there are certain kinds of companies, especially more technology, research, research types of companies that are in the invention business, companies that do a lot of R&D, right? I mean, those kinds of companies frequently come up with great ideas, and for moments, right, maybe a year, 2, 3 years, they may have very high monopoly powers in an industry, so they can earn higher earnings per share. And again, if they get higher earnings per share and they keep their dividend payout ratio constant, that means higher dividends for shareholders. So in this example, we have a company that's going to have an above normal rate of 12% for 4 years. And after that, it'll go back to the industry standard of 9%. Now, the most recent dividend was 4.25, required returns 20%. Again, this is referred to as the supernormal stock valuation. It's not a constant growth model, right? It has a variation. This stock ultimately then has a value of $46.31. So we can apply the same basic concepts of present value and time value to companies that don't necessarily follow the rules with respect to constant growth. So what are the limitations, right? There's a lot of uncertainty associated with forecasting. That's always an issue in making business decisions, of course. And of course, small changes in dividend growth rates can make large changes in estimated stock price. So, it is a very sensitive model, and frequently will give answers that don't necessarily make a lot of sense relative to the current stock price. So how else can we find the value of a company? Let's look at a couple of different formulas here, a couple of different models. The first one we want to talk about is something called the total payout model. The share repurchases. When a company buys back its stock, puts it into treasury stock, shareholders get cash. The implication of that, of course, is that by buying back stock, the company reduces the amount of money available for dividends. So this total payout model refers to all of the cash that's distributed to shareholders. So we have here the present value in the numerator of all the dividends that are paid plus the repurchases of the company's stock. Divide that by the number of shares outstanding, gives us a ballpark idea of what the value of the company is. Right, this looks at the values of all the firm's equity rather than the single share. That's why we have to divide it by shares outstanding in order to get it down to a price per share model. So, again, if you find the data, here's a little table. You go to the total payout model worksheet, and you can just plug the data that you have for that, and it will give you a value of the stock. So you need to know how many shares have been repurchased by the company. All of this information is generally available in Yahoo Finance. How many shares are out there? What is the dollar value of dividends paid? What do the research analysts give you for earnings per share growth? Now, the thing that you don't know is the weighted average cost of capital. We'll address this in a later chapter, but we can take a shortcut for right now. And if you go to wacc.com, put in your company's ticker symbol, you can ultimately, it'll tell you what they estimate your company's weighted average cost of capital from. Now, once we get to that final chapter, we actually talk about this, we may want to revise some of the numbers that they provide for us. But in general, this is where we want to go, at least initially here. We can revise this and update it a little bit later on. But as you can see here, it says the value of this stock is $22. Coors is currently selling for around $57. So obviously, it's again telling us that the stock is, to a great extent, pretty much overvalued. So what's the next model? The next model is called the discounted free cash flow model. We want to look at the enterprise value of the company. What is this company worth in total dollars? If you remember, enterprise value says, what would it cost to buy the entire company's stock, pay off the company's debt, and of course we would use whatever cash the company had to assist with that. So it's the value of owning the entire unlevered company without debt business. So how can we ultimately work our way through here? What is the value of the enterprise? We want to ultimately measure free cash flow. It's the cash available to pay both debt holders and equity holders. If we find the discounted value of that, again, the value at the top, the value of the stock plus the cash minus the debt. If you can find that value, that will give us a picture of the price of the stock. So how can we incorporate this into a model or a formula that we're a little bit more familiar with? Here is the model, V sub n, right? If n equals 0, we can change that to 0, is the free cash flow next year divided by the cost of capital, weighted average cost of capital, and the growth rate of free cash flow. So how can we find that information? How can we find that data? It's the same formula we had before, so we can use a similar model. But let's continue on before we actually look at how it's used for a real company. So the value of the company is worth the value of the stock plus the value of the debt less the cash of the company. So if we solve for the value of the stock, we take this free cash flow, the class of valuation, subtract out the debt and add the cash. So here we have a company, 7% is the growth rate of free cash flow. Most recent cash flow was $700,000. Weighted average cost of capital is 13%. So this company is roughly worth $12.5 million. The company has $1 million in cash. The value of its debt is $7.5 million, and it has 100,000 shares. So the value of the stock is essentially $5.9 million. Divide that by the 100,000 shares, gives us the ultimate stock price. So there's a free cash flow valuation spreadsheet. Plugging in the data that we have, can we see that ultimately it's worth $59.83 is the value of this example. Can we do the exact same thing with the free cash flow model in our company? Of course we can. We have to gather this data. We need to know something about the free cash flows, right? In this case, it started at 714, ended at 1833, 1839. We need to incorporate that. Can we find a growth rate of free cash flow? If I can find the growth rate of free cash flow, that's a better number. I can just plug that up above. Use the most recent number, free cash flow subscript 0, and go up above. If I want to, maybe I could use the actual present value, right? Plug in 714 here. We've got what, 1, 2, 3 over 3 years. Find out what that growth rate is. But ultimately, we can come up with cores and say this says that the value of the company is $63 per share, which, again, as you know, we talked about, it's roughly about 58. So now this free cash flow model, if you're looking at the cash flow, the free cash flows generated by the company, says that this stock is actually undervalued. It might actually be a good purchase. Hopefully, it's not a surprise that when you look at multiple ways, multiple tools and techniques to come up with a number, that sometimes the techniques will not agree with each other. They will contradict each other. That's why we do more than one. We do a bunch of them. Then we can analyze the data to see what all of them say about the company. So how does this all connect up to capital budgeting, right? The company's free cash flow is the sum of the free cash flows from the company's current and future investments. So the net present value of any project is its contribution to the firm's enterprise value. To maximize share price, we have to do projects that have positive net present values. So how do these discounted cash flow models ultimately work, right? Dividend payments, right? The present value gives us a stock price. If you look at total payouts, that talks about equity value. If you look at free cash flow, it's ultimately determining the enterprise value of the company. So there's several different techniques, and they all address a different way of addressing the value of the company. Another methodology for trying to determine the value of stock are referred to looking at comparables. Let's find similar things and see if we can use that information to ultimately come up with a value of what our stock should be worth. So a valuation multiple looks at the value of some number to measure the firm's scale or its cash flow. The first one to kind of talk about is the PE ratio. If you remember, this is the share price divided by earnings per share. Well, when we have this formula, we'll break this down a little bit in class, but we want to forecast what we think will be happening in the future. So here we have this manufacturer, right, has earnings per share of $1.38, and the average PE ratio of comparable companies, 21.3. Plug those numbers into the multiplier model formula for PE multiplier, and it says the value of this stock should roughly be around $29.39. Now we can do the exact same thing with our company. What's the estimated PE ratio, what's the estimated earnings per share for our company? If you'll notice, I have these backwards. Doesn't really matter, it's just a multiplication. We get the right answer, right? But it's $3.98 is the earnings per share. Multiply that by the PE ratio, in this case by the company's predicted, that's $49. But if you look at the industry, this company should be worth a lot more. It should be worth $149. So what this says is the company is kind of overvalued compared to our current industry. But really, when you think of what it should be a much higher price. So there may be some challenges with the management of the company and the efficiency of the company, that they're not generating the kinds of value that the rest of the industry predicts that it should. So again, we have to look deeper into the company. What about enterprise value multiples? There's a number that's produced for us, that's calculated. It's called the enterprise value multiplier. We can find that number.